Sell in May and go away is the typical Wall Street propaganda going into the summer. And although data shows that that strategy historically has made sense, more recently in the modern era, this propaganda is starting to break down. This year particularly, folks, is expected to be, in my opinion, a very interesting year for the stock market. Not only are we in the midst of an election year, which is just starting to heat up based on the news we just saw this week with Trump, but also we are expected to see a pivot in the Fed's stance on inflation and interest rates at a time when these same rates are at highs we haven't seen in almost 22 years. Bonds are at all-time lows, and the performance gap between small cap stocks and those in the large cap sector is at its widest in history, not to mention the prolonged yield curve inversion we've experienced since 2022. So can we really expect a summer doldrum to happen in markets this year when the market has already had a really good run since the beginning of January? Well, as it turns out, folks, probably not. As you can see, since 2014, the average S&P 500% change from the period of May to October has actually been positive more often than not. The only negative times we saw was in the bear market of 2022 and 2015. What's more is the fact that during presidential years, this strategy breaks down even further. As you can see, the average return of positivity between that period is 77.8%, with a median index change of 3.3% for the S&P 500. As it turns out, election years are really good years for most stock market investors, as policy is always shifting towards what the consumer wants, and typically that comes in the form of lower interest rates, lower tax rates, as well as more leniency in the ability for companies to raise money. And as is the case with any major event in markets, buy the hype and sell the news is pretty popular. And markets and hedge funds always buy up stocks ahead of election times, typically in November, and then sell them drastically after if there's a significant change in the administration. And what's adding fuel to the fire is the fact that just on Friday we learned that the PCE inflation came right in line with analyst expectations at around 2.7%. Inflation has cooled down significantly, and particularly on a core basis, the month-over-month number was just 0.2% compared to expectations of 0.3%. Yeah, there are a lot of sticky parts to this inflation picture, like rents and services, which are still going up year over year. But the main goods in the sense of hardware, as well as supply chain and even some utilities and housing, has started to come down, which is an important signal. And what's crazy is that we've just witnessed at the same time the lowest GDP growth on a quarterly basis since 2022. This is exactly what the Fed wants going into November. They need an excuse to increase their quantitative easing to support the narrative of the current administration, which is currently getting grilled because of high inflation and all these other economic woes the middle class is facing. Interest rates take time to affect the economy, and we are starting to see a small portion of that happening right now. And what's particularly interesting is the fact that the Russell 2000 and small caps are actually not even close to where the S&P 500 is at today. Whereas the S&P is at a PE ratio of anywhere from 22 to 24, the Russell is at 15.3, with the biggest gap between those since 2001. A lot of this difference in performance is being driven by highly valued tech stocks, which have great profit margins and are still growing at insane rates, like your Nvidias, Microsofts, and Googles, with all the software and AI that they sell. But At some point, that trend is going to shift, and it will shift drastically towards the smaller cap names that, although are unprofitable and yes, in many ways more risky, are still good opportunities for exposure to hedge funds. The big risk here is obviously something the market's trying to price in, which is the fact a lot of these companies will have to refinance at higher interest rates over the next 5 years. But given the fact that some of these companies are much better than others, and if you pick the right ones with the right industry, such as renewable energy, commodities, or even mining, then you can certainly find really good plays than looking at just the large cap tech stocks. But as usual, folks, that is just my take on the situation. Let me know your thoughts down in the comments section below. Thanks a lot for watching, and I'll catch you guys in the next one. Take care.